Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about sell the rip strategy. This approach can be a valuable addition to your trading toolkit, potentially helping you to capitalize on the market reversal. So by the end of this video, you'll be able to understand how to identify, execute, and manage risks associated with this strategy. So stay tuned to learn how the sell the rip might help you in your forex trading approach. Now, what does it mean to sell the rip? Sell the rip basically means a trading strategy that involves selling an asset when price experience a sudden or sharp increase. The approach is based on the principle that after a rapid rise or rip, the market often corrects itself, leading to price decline. As a forex trader, you can use this strategy to profit from the market correction potentially. This is an example of sell the rip, where the market suddenly dropped and created a correction move back up to correct itself. This is an example of selling the rip. The key to a successful selling the rip is identifying overbought conditions in the market. When a currency pair price when the currency pair price rise too quickly, it may become overvalued, creating an opportunity for a profitable short position. It may become overvalued, creating an opportunity for a profitable short position. This strategy requires careful timing and analysis to execute efficiently. It's important to note that sell the rip is not about predicting market tops. Instead, it's about recognizing unsustainable price movement and positioning yourself to benefit from subsequent corrections. Now, how do we execute this strategy? We execute the sell the rip strategy effectively. To execute this strategy effectively, it requires careful planning and precise timing. Let's break down the key steps that you would follow when implementing the approach of forex trading. First of all, you identify the currency pair that is experiencing a rapid price increase. Look for a sharp upward movement that seems unsustainable based on your analysis. As we can see, the market is moving in an upward direction, in a very sharp upward direction, and we know that at a point in time, market must want to correct itself based on my analysis. Now let's look at this chart. Let's mark out some areas in price that we expect the market to react from. Now, based on my analysis, I can see that after market broke through this resistance area, market hasn't come back to retest this area, knowing fully well that after a market moves in an upward direction, market must surely decide to exhaust. It has to relax or pull back, correct itself before it continues in that rapid direction. Once you have spotted a potential rip area, you confirm using the overbought condition using the technical indicator known as the RSI. The relative strength index and the stochastic oscillator can be particularly useful in this area. By imputing these indicators on my chart, it makes it easier for me to be able to spot areas of overbought and oversold regions. This means that this area in price has been overbought. From the stochastic indicator, we can see it is trading above 80, showing that we are in an overbought region. And we can see from our RSI, it is trading above 82 and as well. The next is to determine your entry point. A common approach is to wait for price to show signs of reversal. This could be a bearish candlestick pattern, or this could be a break below the short-term support or resistance area. If I'm to draw a short-term resistance area on this chart, I will draw this short-term bearish candle, or to be more conservative, I will draw this area. So this is when we can spot the market is willing to reverse, when price break through this area. We have to set our stop loss. We set our stop loss above the recent high to limit potential losses if the upward movement continues. So after this bearish candlestick pattern, or it breaks this support area, our stop loss should be above the swing low, just in case price reverse against us and doesn't want to continue, or price doesn't want to reverse at this particular time in the market. We keep our stop loss at this area to safeguard ourselves. Remember, proper position sizing is crucial. We can also put our stop loss based on Fibonacci retracement level, above the Fibonacci retracement level. Areas where we assume we mark our Fibonacci retracement from. We can decide to put our stop loss just above the Fibonacci retracement level. And our profit target can be targeted as a 1 to 3 risk to reward, or we can use the Fibonacci extension level as a particular place we can decide to take profit. Proper position sizing is crucial. Never risk more than a small percent of your trading account on a single trade, regardless of how promising it may seem. So when we are risking any amount on our trading account, we should make sure that we are risking nothing more or nothing less than 1% of our trading capital. 1 or 2% of our trading capital should be an ideal percent to risk per trade. As the trade progress, consider using a trailing stop to protect your profits while allowing the trade rooms to develop. This can help you maximize your gains if the price continues to fall. To help you maximize your gains when price continues to fall. So including a trailing stop loss is also beneficial in this strategy. Now let's look at some common mistakes to avoid, or some common pitfalls to avoid while implementing this strategy. When implementing the sell the rip strategy, it is crucial to be aware of some common mistakes that can derail your trading efforts. Let's explore some of these mistakes and how you can avoid them. One of the most frequent errors is mistiming the market. Selling too early might cause you to miss out on potential gains, while selling too late could result in losses. To avoid this, use technical analysis. Technical analysis indicators such as the RSI or the stochastic oscillator to confirm overbought conditions before making your moves. Always don't forget to mistime your trade. To avoid mistiming your trade, anytime you see such an opportunity, you enter after you see your confirmed pattern. You see your confirmed pattern, your confirmed candlestick pattern, you enter your trade. Or when you see price has broken a confirmed structure area, you enter your trade. Another pitfall we need to avoid is ignoring fundamental analysis. While technical indicators are important, Overlooking economic data and news events can lead to unexpected market moves. Always stay informed about upcoming economic release and central bank decisions that could impact your trading. Always remember that we have to check our news calendar to see if there is an upcoming news coming in that might disturb the market momentum. Another common mistake we need to avoid is overtrading, especially for new traders. The excitement of po ten tial profits can lead to excessive trading, increasing your risk exposure. Set a limit on the number of trades you take per day or per week and stick to it. Now the last mistake we need to avoid is failing to use a stop loss. This is another critical error. Proper using of proper risk management on a single bad trade can wipe out your entire capital or your gains. Always set a stop loss order to limit po ten tial losses. Lastly, be conscious of average drawdown. Adding more position into your losing position is a very quick way to lose more. The strategy can quickly amplify losses in the forex market. Instead, stick to your initial trading plan and exit losing trade accordingly to your predetermined criteria. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.